Good afternoon. This is Jim Barlow with OakTree Strategic Leverage. I'm in Orlando for this week and next week with Barbara. We're just relaxing a little bit. I'm out on the patio. You might hear a little bit breeze. You might hear there's a little lake on this resort location. Maybe there'll be some loud noises in the back. Hope not. Anyway, welcome to the webinar. Is there a better way? The Inversion Wealth Framework and the Kaizen Strategy. Always want to remind people who I am, what I'm doing. Jim Barlow, lifelong resident of Clearfield, Utah, married Barbara. We have 7 children, 28 grandchildren. We have a great-grandchild on the way, probably in June. I'm a BYU graduate. Had 2 grandchildren graduate from BYU just last week. That contingency is growing. We're devoted fans. I've been an investment advisor for 35 years. Wow. Family's everything to us. We love to travel. We like to be together. We like to go with family on travel. We serve in the temple. And the reason I do this business is it's my part of doing good and helping others. So here we are. That's my picture from our reunion of 2 years ago. We do a family reunion every 2 years. This one was in Heber City. The 1st of July, we're doing a new one, and it's up in Bear Lake. Should be a lot of fun. So let's go to work. Is there a better way? The Inversion Wealth Framework and the Kaizen Strategy. Win without losing. Wow, if we can do that. Most people iceberg in this presentation. They focus on returns and growth and upside. But what actually causes failure lives below the hidden risks, the timing pressures, the forced decisions. Inversion thinking starts where others don't look. Is there a better way? Let's take transportation. At one time, there was just horses, and then cars started to come around, were being made. And of course, Henry Ford figured out a way to mass produce some cars. We're starting to talk about self-driving cars. I have a son who has a Tesla, and he says as soon as those self-driving cabs come out, he's going to buy one and send it to work. Planes. Oh, wow. Transportation. Progress didn't come from improving the horse. There's a new structure put together. This is happening in a lot of areas. Community. I have my dad's World War II letters. Very slow communication. Then phone and email and texting. I can talk to text with all my grandchildren so easily, wherever I am. Information library. We had Google, and now we got AI. Entertainment. We used to have antennas on our houses. We had rabbit ears on our littler TVs. Went to cable. Now we're into streaming. Energy, wood, coal and oil, natural gas, electric. Commerce, local stores. Now we have Amazon and global commerce. Wow. Progress didn't come from improving the horse. It came from replacing the structure. So what is inversion thinking? It's a way of solving problems backward. Instead of asking, how do I succeed? You ask, what would cause this plan to fail? Then you eliminate those risks first. The inversion principle. Most people ask, how do we succeed? Inversion asks, what could cause us to fail? In business retention, avoiding loss matters more than chasing upside. The power of inversion. Charlie Munger is probably the major proponents of inversion thinking. It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. Protecting the downside, remove the cause of loss. Progress compounds. Here's some other quotes. The father of inversion thinking was Carl Jacobi, a mathematician in the 1800s. Invert, always invert. Charlie Munger quoted him a lot. Nazim Nicholas Taleb, the first rule of risk management is to avoid ruin. Ray Dalio, don't confuse what you wish were true with what is actually true. Nadel Ravinkin, I don't even know how to say his name. Don't focus on winning, focus on not losing. I love quotes. I collect quotes all the time. My friends know this. Over the years, I've collected thousands and thousands of quotes, but I have 100 quotes on inversion thinking. If you like a full list, just email me or text me, and I'll share this list with you. So, how do these failures show up in real life? Sequence losses. This is really bad in retirement. Losses at the wrong time. Emotional decisions. Oh, I've seen that happen a whole lot. It's sad. Unprotected leverage. Oh, too much leverage. Unprotected. Forced liquidation, selling without choice. Tax drag. Inflation erosion. There are risks. We want to protect as much as we can from the risks. Permanent loss compounds faster than growth. There's also just delayed decisions on known problems. You know what I really said there? I said procrastination. No will, estate plan. State decides. Delayed tax planning, pay more later. Delayed life insurance, cost goes up, maybe uninsurable. Waiting to invest, missed compounding. No income strategy, retirement risk, ignoring long-term care. Family burden, unfunded obligations, forced asset sale. No buy-sell plan for businesses, business at risk. Permanent loss compound. Oh, I'm sorry. I was thinking I had a buzz line there. There we go. Permanent loss compounds faster than growth. Oh, that's where I messed up. The pattern, I'll do it later. Woo. Fewer options, higher costs, less control. How most people invest. The traditional way is you try to pick better investments. You diversify, you maximize return. Still, you're exposed to market losses, dependent on timing, vulnerable to human behavior. Inversion investing thinking is avoid ruin, structure first, leverage wisely, preserve control. Here's what I've built and designed, the Inversion Wealth Framework. I see it 4 steps. The first, the foundation, is this inversion thinking. Just avoid ruin. Think about it. and look for it. Find a structure, a system that complies with inversion thinking. Then you can leverage this. You can multiply it safely and then let compounding just happen. Be patient. All four, or patience is especially important. That's my inversion wealth framework. Let's go over each one a little more detailed. Avoid ruin first. Identify what destroys wealth. Eliminate irreversible risks. Expose hidden vulnerabilities. Look hard. Think through it. Go over it. Win by not losing. Layer 2, build what cannot break. Protect against these forced liquidations. Maintain control in all environments. Ensure liquidity when it matters most. If it can break you, it doesn't belong. 3 is the leverage. Use capital more efficiently, not reckless leverage, structured leverage. Defined entry, controlled exposure, planned exit. More capital working without much risk. Last is the patience. Let time do the heavy lifting. Compounding requires stability. Stability requires structure. Time rewards what survives. Everyone kind of understands 3 of these. Inversion, see the risks, find them out. Leverage, increases potential. Patience, let it compound. But they fail in one place, the structure. Structure is the bottleneck where execution breaks, where risk is left exposed, where plans rely on behavior instead of design. This is where most people get stuck, not because they don't understand, but because they never built what makes it work. Structure before strategy. If the structure is wrong, performance won't save you. If the structure is right, you don't need to be perfect. The right structure becomes the fulcrum. Small inputs create large outcomes. Leverage becomes safe and predictable. Time begins working for you. Structure is the edge. It's not just where things change, it's where power is created. Most people try to win with better returns. The few who consistently build a structure that can't break, and then they let leverage and time and patience do the work. We read through that. All right. If you know what destroys wealth, and we know what a strong structure requires, is there a system designed to solve for all this that will protect against loss, create tax-efficient outcomes, use leverage safely, provide liquidity, or are we left trying to build it ourselves? Well, I found a structure that I think is amazing. The company that built it is a company out of Texas called NIW. They the product Kaizen. Kaizen is a Japanese word meaning continuous improvement. That's a great message for all of us in life, continuous improvement. And their buzz line is more money, more protection, more confidence. That's pretty nice It's in line with inversion thinking, more money, more protection, more confidence. So Kaizen is a transformative structure built on a cash value life insurance, an index universal life policy that eliminates downside risk, uses institutional leverage, creates tax efficient income, defines a clear and exit strategy. In a real one slide. Excuse me. Well, maybe it's the wind. I'll keep talking. Here's a one slide simple version. You contribute for 5 years. That's it. The bank contributes additional capital alongside you. Then the bank continues funding for the next 5 years. So there's 10 years of funding. The policy grows with built-in protection. The loan is repaid around year 15. From that point forward, the structure is fully yours, unencumbered, income ready. Why it fits this framework, why it's transformative. Inversion, downside protection, zero floor. I'll show you how. Structure defined system, not market guessing. Leverage about 3 to 1 institutional capital. Then long-term, patience. Obviously, you saw just 15 years. It's not for the short-term person. I guess I should have mentioned this too. It's not for everybody. It's for high-income earners, business owners, professionals, families thinking generationally. There's 6 major reasons people buy it. There's other reasons. Retirement income is the number 1. Probably the number 2 is family gifting. Number 3 is probably executive and employee retention, business succession, just tax efficient income or creditor protection. These are probably the top 6. We do a webinar on the retirement income, family gifting, employee retention, and succession. Today is the general webinar. Qualifications. It's designed for people 18 to 65. Health typically requires standard or better. Obviously, if you're uninsurable, you can't have it. But actually, lower levels of insurability, more expensive levels of insurability, it's not going to work either. Standard or better. Income, 100,000 annually or more. Actually, probably 200,000. I just didn't want to put that down. Plan funding, on a minimum level, 20 to 40,000, depending on age. And I've always shown you the long-term 15-year commitment or longer. Guidelines vary by carrier, the insurance company, and individual circumstances. There's the general qualifications. I'm going to go through what I think are the 4 major components of Kaizen: the foundation, the growth, the control part, and the leverage. Probably not comprehensive, but we couldn't be totally comprehensive in a webinar, but here they are. Foundation, the financial security, the protection. It is a chassis, it's a chassis of life insurance. So you have death benefits, immediate transferable wealth efficiently if something happens to you. You also have living benefits, protection when life doesn't go as planned. I'm going to give you, well, let me go to this slide, then we'll come back. These living benefits came about from about 1980 on. You have chronic illness protection, long-term care insurance, terminal illness protection, Critical illness, that's the major health events or critical injury, support of severe injuries, or even cognitive impairment. These are protection against GoFundMe accounts. Every company is a little different in how they approach it. Some of them are not offering all five. But anyway, living benefits, a big deal. Let me go back. The third is tax-free growth and access. When there's cash value growing in a life insurance policy, it grows tax deferred. And it becomes tax-free, totally tax-free to the beneficiaries when the owner passes away. You probably knew that. But you might know that you, as the owner, can borrow from this policy tax-free. That is how we approach retirement. So you got tax, because it's a life insurance policy, you can have tax-free income. And you have some built-in efficiencies. No ongoing advisory fee or management fee. Yes, there are insurance costs, which I'm going to address in a bit. But you have insurance costs, but none of these advisory or management, which has become quite sizable. So that's the foundation. Then we go to the growth part. Market-linked growth. Participate in market gains. You're looking for about market returns, and we have zero downside floor. There's no losses in any year. Let's go and show you how this happens, then come back. How indexing works in an index universal life policy? Most of the premium is allocated to high-grade bonds, with a small portion used for index option growth. So out of $1,000 going towards the cash value, probably about 950 or more or less is going to go into the bonds, which grows back to 1,000 in a year. Then the remaining amount, small amount, $50 in this example, would be put into options. We're buying options linked to different indexes. We're duplicating market returns with the safety of the bonds. So we can get market type returns with no market time loss. Inversion supreme. Protection first, growth second. That sequence is what makes this structure transformative. Let me give you an example of just two different situations. National Life Insurance has two different types of indexes. One is the Standard & Poor's 500 index. You get 100% of participation, obviously no downside, no negative years, but that option money can buy us not all the upside. So there's a given cap at a given time. Currently, it's 11%. So if your index does more than that, you don't get all of it. But if the index does 10, you get all of it, 10. Or you get all of 11, but there's never any negative years. Here's the 5, 10, 15-year averages on this capped approach. Then we have funds that they buy options on with a participation rate and no cap. And this US Pace Setter Index is a volatility controlled index, which we won't explain in detail today, but it's a lower risk fund, and we can buy more participation. Currently we can buy give you 260% of the index. Not just 100%, but 260 with no cap. And there's the averages for 5, 10, and 15 years on this lower volatility approach. So they're both good. They're both just different. That's where it's invested. And so now you kind of get a feel for why there's zero downside and you get market-linked growth. And when the market's had a negative 20-year example, for example, you're at zero, and when the market turns around, you don't start from a negative 20, you start from zero. So continuous compounding, no recovery years required. You don't have to wait to recover where you left off. This is the growth part. Pretty exciting. This is what we already went over. So then there's the control part. Protected ownership. We set Kaizen is set up in a trust structure. We set up in a trust for you, the investor, your own trust. And then we have a master trust on 100 policies in a tranche. And that master trust is doing the borrowing with the bank, managing all the policies and doing that behind the scenes work. If you don't have Kaizen, you'd be doing this behind the scenes work yourself. We built this on only 5 years of payments. I'm going to show you how that works in a minute. That's projectable. You can figure out 5 years in most cases. We had a bunch of key riders designed to reinforce, control, and protect the structure. The riders are essential, important. Then we have flexible liquidity. You're going to have more access to cash without taxes, without forced withdrawals, no required minimum distribution because of this structure. And very turnkey. When you have something that can't go down, have a negative year, you don't need to do a lot of management. They're very turnkey and easy to follow. That's the control part. Then we have the leverage. When you have this control and you have these protections, you can feel comfortable doing a leverage portion. We don't do 20 to 1, we do about 3 to 1. More capital working from day one as bank puts money in. Non-recourse structure, no personal guarantees or outside collateral. Accelerated outcomes, reach objectives sooner because of borrowed money. This efficient personal asset. You can leave those other funds in your business. You can leave things alone that you wanted to put because you borrowed money. You haven't used all your cash. Efficient use. Here's how it looks. I mentioned the 5 years. That's this 5 silver pigs in my diagram. And the bank is putting in approximately the same amount for the first 5 years. Then, after your 5 years, the bank continues to make the payment they were paying for the first 5 years, and they pick up what you were paying for the first 5 years. So graphically, it almost looks like 3 to 1. And I'm going to give you a hypothetical so you can see real numbers in it, just a jiffy. But there's the 10 years of payments, 5 on your part, 10 by the bank. And like I mentioned, no personal guarantees required, no outside collateral, no traditional loan process, institutional underwritten, built into the structure. I guess I should say this isn't about eliminating risk. It's about structuring it so it can't break you. Okay, I mentioned costs. Yes, life insurance has a cost. As an investment guy, it'd be nice to be able to say it's 1% every year, but it can't say a percent because it depends on death benefit, the age of the person, the health. So a little more nebulous. The question is there a cost? You know there is. The question is, does the structure create more value than it consumes? What the structures enables, downside protection we've talked about, the tax advantage income, tax-free, with a death benefit, the leverage, the liquidity. The goal is a structure that produces a superior outcome. I'm going to give you a hypothetical. NIW, the founders, designers of Kaizen, have put together a website. The name of it's in the upper left corner, Interactive Learning Information Assistant. We call it ILIA. And the index on the left side, it has a lot of information, but the part that I use almost daily is the estimate my benefits. And that's what I've done. I've used this website to create this benefit example. So my hypothetical, I'm going to use a 46-year-old male with excellent health, who's willing to put in $70,000 annually for 5 years. Now, the reason I chose 46 and 70,000 is that's the average age of a Kaizen buyer in the country. And the 70,000 is the average amount people put into it per year for 5 years. There's lower amounts put in than that. There's higher amounts. The highest that I was involved with was $1 million a year for 5 years. And in my hypothetical, we're going to show distributions to this person from 65 to 90 as a retirement income. We're going to use a illustration rate of 6.81. That's regulated by the National Association of Insurance Commissioners. That's the allowable rate. We've averaged higher. Kaizen's average higher than 6.81, so this is a conservative hypothetical. I'm going to show income tax rate of 37% total and capital gain rates of 20%. Here we go. This is the information I'm going to give you. I'm going to show you some comparative investments. We're going to show you after-tax investment, a tax-deferred investment, IRA, 401k, and Kaizen. Beginning distribution 65, the total distribution through 90, the initial death benefit, and the death benefit remaining at 90. Here we go. After-tax investment. This means just making that 6.81% for all the years from 46 to 65. This person could start taking out after tax $58,642 or $1,524,000. For this to give as much income as possible for my illustration, I used every penny. The income, if at 91, is 0. We've used every penny to give that as high as amount as I could. Now we're going to do it in a 401k or an IRA, and it's higher. That's quite a bit higher, 74,106,000 or $1,926,000. Tax deferral, as long as income tax rates don't go up, is a viable, worthwhile thing to do. Now, Kaizen. I call this the drum roll, please. I'm going to show you the Kaizen starting at 65. Is it going to be higher than 74,000? Maybe 10,000, 84,000, whatever. Here we go. 130,000. That's quite a bit higher. That's a lot higher. 3,380,000 through age 90. Death benefit beginning of 46 of 2 million, and even a remaining of 90 of 1,702,000. Could this Kaizen policy continue to pay the 130,000? I believe it could. I probably should use another line to do to 100 or something. Anyway, 130,000. You know what people ask, or what they say sometimes in a live webinar or a live presentation? They say, this looks too good to be true. Well, it is good. What this means is we overcame all the insurance costs. The tax-free, the no downside, the lower fees, all these things were working in your favor, that it comes out with a higher number. It looks too good to be true. You're getting virtually insurance free. I love Kaizen. I think this is, well, yeah, let's keep going. So, Kaizen, NIW, wanted to stress test this against the two worst case environments. One is the 1980s high rate environment. Loan rates reached 16.88%. So they're going to they simulated that if you were buying this in the 1980s, how would you do? And they simulated in the Great Depression, the worst sequence of returns in U.S. history. In the sequence, they put 9 years of zero return over 12 years. Remember, we don't have a negative year, so the worst year is 0. And we did it 9 years out of 12. Let's show you how these Kaizen did in these stress tests. 1980s, 97,500. Well, it was 130. Things can be lower, but still higher than the 74 substantially, or the 58 substantially. It works in bad interest rates environments. Oh, those first two I didn't mention, but those first two would go down in these environment too. Using the same percent of down, I'm projecting that the after tax would have been 43, the other would be 55. So 43, 55 to 97 in a bad interest rate environment looks nice. Well, let's look at the Great Depression. Oh, it's a little worse. 84,000, still higher than the 74. And these would have gone down too to 38 or 48. 84 is looking pretty good, better than the 58, 74, 38, 48, but not the 130. Now I got another drum roll, please. What could I do for another drum roll? Wow, what could I be doing now? Allianz, one of our insurance carriers that I really like, wanted to see if this ILIA illustration system was accurate. If there's some flaw that we weren't looking at. And so they studied it and researched it and analyzed it. And they said there's an 80% chance that the 130,000 that were projected here, an 80% chance that that 130,000 is going to be double. 80% chance. I should probably put this is too good to be true. So there's the whole picture. Using the 6.81, we got 130,000. We've got the stress test amounts. We've got the potential double. It's too good to be true. So I did something else. What if this guy didn't have excellent health? Well, the 130,000 goes down to 120. Well, you can have not excellent health and still beat the options. That's good. I like that. Well, what if it's a female instead of a male? Well, instead of 130, it went up to 133,000. Females live longer, better health. So here's the numbers for a female. So excellent health female, excellent health male, average health, all looks nice. So now let me show you another study. The very first policy issued was in 2012. One of the owners of NIW, and this is her, she gets a statement once a year, and the last statement is June 27th, 2025. And this is what her performance. She's averaged 7.85 for all those years. What have we got? 15 years? 13 years. Can't add very good, sorry. 7.85. She's paid on the borrowed interest money. She's paid 3.95 interest over all those years. Therefore, we can create a spread. 7.85 subtract 3.95. She's made 3.9% on her borrowed money. 7.85 on the money she put in, and 3.9 on the borrowed money. Then I put down here, long-term historical SP 500 averages 10%, about 10%. So Jim, that 7.85 doesn't look as good. I was hoping I'd have 10. Well, let's see, Jim, or 7.85 is tax advantaged. That means you're getting that 7.85 tax free. And so if we take just 25%, saying tax at 25, you'd be 7.5 or lower. So is it competitive with the market? It's competitive with the market more conservatively. I want to add, I should have added this to the slide, but they did another study and looked over all interest rates environments from the 1930s through now, and they found out that any 15-year period of time, there's never been a time when the spread would have been less than 2%. Never anything less than 2. So you basically, the borrowed money, you might say you have a range of 2 to 4 on the borrowed money, maybe higher than 4. Not in the past, but maybe in the future. The Kaizen principle. Most people focus on outcomes. Wise people focus on how the system is structured, because results rarely fail from lack of effort. They fail from poor design. Inversion teaches us to ask a better question. Not what results do I want, but what structure produces that results consistently. Because success is not an event, it is a system. Structure first, results second. Transformation follows structure. That's the message today. How can you learn more? I've got 4 ways. We have a landing page, I'll call it, that has videos. It has chapters, so you on every segment of Kaizen. And you can use this QR code and go to this site. I won't know that you've gone to the site. You're not revealing a secret to me that you're there. And you can study it as long as you want. And you can call me. I've got my phone number on this site, so you can call me or you can text me. Did you hear the helicopter? Can you still hear me? Sorry about the helicopter. So this is a great resource. All on your own, you can study it out. See if what I've been showing you is correct. Another one, similar. This landing page is focused on just gifting, Kaizen for a gift. So if you're older and you want to give to your son or daughter or grandchildren, this is the one to look at and study. Same chapters and videos and lots of information. Those are two good sources. There's also this ILIA that I showed you. This one here, you have to have a login and password. And if you want to start right here, here's a lot of information too. Would need your birthday, your name, obviously, your email address, and your cell phone number. And with that, I can send you an invitation, and you can go to here and use this exact estimate my benefits that I used. You can change the scenarios and try it all you want. This is also the site that you actually push a button and say, yeah, I want to get Kaizen. And then I will get a notification that you're starting the process, and I'll guide you through it as you have questions. The fourth way is just my website. I love my website. I think I built it really well. There's lots of stuff on it. This is the opening page. I have a lot of quick links to information that could be helpful to you. And I build a retirement income gap calculator. It's free on there. I've got the basic and advanced. You can do the basic with don't grab any papers and information, just ballpark it, and you can see what is the gap? How much do I need to get more together to fill the gap of my retirement? And the advanced one has Social Security and 401ks and all that and built into it. But I love them. I spent a long time thinking through them and haven't had a great helper to help me design them. Anyway, my retirement income gap calculators. How do you want to engage? Those first two options I showed you is kind of a Kaizen online, advisor backed question. Anytime you have a question, but you can kind of just look it over on your own time. It's almost the Amazon approach. Or happy to do a one-on-one, happy to take you to lunch, go to dinner, answer questions, talk about your personal strategies and issues, whatever feels best for you. You know, this is the same strategy, how you approach it, just different engagement styles. The right path is what fits how you want to do it. After you buy it, I want to mention the service. There's myself, OakTree, but then there's the program oversight by NIW, the founders that are continuing to monitor the structure and send out the statements and coordinate the parties. Then there's the institutional parties. There's the insurance carrier, there's commercial lender, there's the trust company. We've got a lot of entities watching over this thing. So you don't need a lot of help either. But anyway, even if I'm no longer involved, because I am getting up there, you've got something that you're going to have continual service. Here's a list of my webinars. Monthly, I do this one. That's the first one on the list. Inversion Wealth Framework and Kaizen, the flagship. The next one I do is retirement income, more specialized, and I do the family gifting. Bi-monthly, I do executive employee benefit. Bi-monthly, I do the business succession. I've got all those that I'm doing all the time. The last three, I haven't actually built them yet. I need to get a little more work done and get those done, but those are my objective. These are the two webinars. I got one next week on May 5th on retirement. Then I have one on May 12th about gifting. And I haven't booked the rest of May. I'll get that done. But you'll hear about those on May 5th when the other ones are coming up. I don't have the, haven't put the link I see there for the May 12th one. But that link there, you can take a screenshot and then now you can link up to the webinar on the 5th. What clients tell me matters most to them? They like the zero downside floor. They really like that. They really like the tax-free growth and access. They like the 5 payments only. They like that. Oh, and we get life insurance and death benefits and living benefits almost free for these early years if we need them. And then the end result, we got this flexible liquidity. None of these are about chasing higher returns. They're about removing risk, increasing control, and creating certainty. That's what people like. So after 35 years in this business, I've learned that to separate products from structures, most financial tools are products, a stock, a bond. A few are structurally built. When someone has the runway, the time, and the health to qualify, I've yet to see a more efficient long-term structure than Kaizen. So I hope you've enjoyed this webinar today. Is there a better way? The Inversion Wealth Framework and Kaizen. There's those 2 QR codes. If you didn't get it, oh, you know, I can see I was a little long-winded today. This isn't as long as I don't like to take this long, but I guess I have. I hope it hasn't been bad in the noise out here in the open air. Real pretty blue sky today, white fluffy clouds. Water is nice. Anyway, have a good day, and we'll talk to you next week as you come to the next webinar. Bye.